There's no way of returning to our normal routines absent an effective vaccine. That's a given. But in aggregate, this country has shown an amazing ability to rise up against the challenges and adapt by figuring out how to continue doing business even while it remains unsafe to do so, and many of the things we all once took for granted. For instance, the US housing market continued its rapid recovery, despite the fact that open houses were completely banned in many parts of the country for a long period of time. Yet amazingly, this did not stop the total transactions of this year probably surpassing the ones that happened in 2019. One mistake that I think many investors have made during this unprecedented period is substituting a forecast of the virus for a forecast about the economy and the financial markets. So despite the fact that more Americans contracted the virus during the last wave versus the horrifying moments of March and April, the economy was able to operate at a higher level of output than previously thought. The goal today is to review what happened in 2020. This is the Beyond Return Show, a forum about business, markets, financial planning, and more. We are here with Montebello Avenue's founder, Robinson Crawford. Robinson is a certified financial planner who serves over, I don't know how many clients locally and throughout the country now. My name is Gabe Kaplan. I'm the founder of Wealth Habits, a financial planning firm, and Strategic Investors. I'm also founder there. I'm a financial advisor, and I help people invest and manage portfolios for them. Given my background as a CPA, I also help them figure out strategies to optimize their taxes. For today, we have the review of the year 2020. It's been, let's say, a year to remember, with unfortunate things happening of COVID, but also amazing or incredible recoveries of the markets. I couldn't even believe that has happened, such as like the implementation of a vaccine, coming out with a vaccine for something that usually takes years to develop. I think the first part we could probably talk about is the long-term effects of COVID. This year onwards, we're just going to see a working from home. That trend is not going to stop. It's just people have, the gates have opened, and I guess employees have been unleashed into working from home, which is good and bad. We're going to see those effects in many markets, right? So I think houses are eventually going to have to become bigger to accommodate for home offices. I think also we're going to have a little bit of decentralization from urban centers. So what that means is that people are going to be able to live a little bit further from those job centers, right? If they're only commuting in a couple of days a week, that's great. But other than that, I think there's a ton of other things that we can talk about. I just wanted to get some of your points here.
I'm with you on the work from home being maybe one of the biggest long-term trends. A lot of changes that have been made there. I think you can expect some level of permanence there, right? When these big employers are planning for their future, they're being very strategic about whether they are okay with a certain subset of employees working from home or not.
Yeah.
Obviously, there's going to be back and forth, pros and cons to each set of it, but I'm definitely very bullish on the hybrid model too, where someone has the option to come in a few days a month, right, or one day a week. They're in the office, and the rest they work from a home office.
Did you work for a company? I don't know what you did in your previous career. But did you work for any company that had a hybrid model before?
I didn't. No, I worked for a different financial advisory office, and it was office every day. I didn't pull the work from home move. I think I probably could have, but I didn't even think about it. Right?
Yeah.
Didn't even suggest it.
Yeah. I worked for a consulting firm, and they don't have enough office space for all their employees. It's a given. You actually have to reserve your office space like weeks in advance. Or even, well, in most cases, some days in advance. But if you want a permanent desk, you probably need to have it a couple of weeks in advance. And so what that meant was that, they could optimize way more. They had a set number of employees, but the office space was smaller. So their expense in office space was smaller, and probably their profits much bigger. It's much more profitable to run an organization like that. I think you're just passing on those costs from like the employer to the employee, right? Because like you're forcing them to get like a home office, and you could give them a couple of $1,000s, but it won't. I think the costs are much greater to have a home office. What about education? What's your opinion there? Do you follow Galloway, that professor from NYU?
I've seen a lot of his videos have gone viral. I love his conviction. I'll put
Yeah,
it that way. He's fun to watch. He's always got hot takes. I think his take was basically that at the top end, where the brand name still really matters, those institutions are not likely to suffer, like the Ivies,
yeah,
right?
yeah,
That's still going to be worth what it's worth. The middle market, the big middle of education, I think is already suffering greatly. I think we'll continue to suffer. I can't even think through what the possible implications of that are. The way that it affects me in my world is basically I'm asking clients for their kids who are young or even, 8, 10, 12, kind of middle childhood. What do you think about the future of college for them? And their answer is, I don't know. This looks different. I don't think they're going to want to go to college on Zoom. We're definitely not going to want to pay top dollar for that. We'll see, right? So a lot up in the air there.
yeah. For me, I mean, I love Galloway. Super. His conviction, as you said, is like strong. I think there's a little bit more nuance to that, though. You're going to have those technical schools, engineering. They will be shifting their education to even something more practical, right? I think that's where you're going to see a little bit of a shift, and they're still going to be teaching, um, in person, right? Because there's a lot of stuff you can do in person. Like in engineering, you actually need access to equipment, and so that is a requirement. And so you need those institutions to provide that. Otherwise, like liberal arts, yeah, I don't know. It's a tough sell. I think even in California, it's very different. You have a lot of people going to those community colleges, and then after 2 years transferring in to the UC system, and that saves a lot of money for people, and it helps if you don't have, or if you haven't saved enough money for a full college experience.
Agree. I think the big trend here is that as a buyer, if you're a future buyer, if you're a parent right now and you're a future buyer of secondary education, college education, or beyond, things are looking good for you. This trend of incredible inflation in the price of those, I think we're seeing that break. The value proposition is going to get it's just more competitive. They've got to bring up the value proposition given this like massive change in what's going on. And so I think it's good for buyers,
Yeah.
right? Good for future students.
Do you think, though, you still would recommend someone to save in their 529s, right?
Yeah,
That's
definitely.
Yeah, I think so too. The question for me, I mean, I always tell clients, like, if you're not going to spend that money in the college education, it'll be there for the MBA or for medical school or for law school, right? Like you can still use it, and there's a good chance that some or one or many of their children will end up in professional degrees. The other thing we saw this year, which was, in my opinion, was like a dichotomy, right? It was like the big state, right? Like the influence of the government right now in all aspects of this COVID pandemic, um, coupled with protectionism and at the same time multilateralism, like coordination between countries of like the vaccine. You have the three big companies who developed these vaccines, and it was AstraZeneca, Moderna, and Pfizer, BioNTech. Most countries ended up buying a portion of each, like a couple of doses from each company, just in case, to hedge their bets, right? So, in that case, that I think there's some coordination there of what to buy, where to produce, um, and that flow of trade is actually really open, right? Because I mean, it has to be open. But on the same time, you have this notion when the pandemic started that we didn't have enough masks, we didn't have the production of masks. It was a disaster. We all really, it opened our eyes that we were reliant on like China and other countries for the production of the basic materials that go into the production of medicine, right? So at that point, I think there's going to be some future thoughts on that, on the basis of national security, I think.
The way you framed it is really interesting. I'm with you on the masks coming from elsewhere, right? They're manufactured elsewhere. We're reliant on a big global supply chain to get them to us.
Yeah.
We straight up didn't have enough. I learned this year about how much of our generic pharmaceuticals are manufactured in Mexico and India and elsewhere, right? That we don't have great great visuals or insight into what's going on there. It reminds me of, I don't know if you've read any books by Daniel Yergin. He wrote one called The Prize. He's kind of an energy historian.
Okay.
And he's written a lot about kind of the balance of power, shifts of power around energy production, right? It kind of starts in the 60s and 70s, oil, natural gas, how that affects geopolitical things. It's a fascinating read to pick up a Yergin book. But it sounds like we sort of solved energy this decade, right? Like there's now enough energy production in the world. It's going green. That's a huge theme of 2022. But the question of national security around supply chains shifted maybe from energy to like pharmaceuticals, right? Biodefense, just a totally different paradigm than in the past.
Which brings me to like, I think, in the end, there will be a revision of all the supply chains and making sure that we're not too exposed to a single country. We also saw that with the trade war with China, right? Like a lot of folks are now thinking about the supply chain and kind of diversifying it away from that, that massive production facility in China that they might have.
Just in time, right?
The just in time.
That's. Can you explain what that means to the viewers?
Yeah, so just in time manufacturing, it typically is related for manufacturing, but a factory usually has inputs and outputs, but the inputs that they carry an inventory, and that inventory is there just in case something happens to the supply chain. But that obviously, if the supply chain is broken at some point for a long period of time, that the whole production will probably fail because you don't have supplies to maybe one of the supplies for the outputs. And so that has been an ongoing theory just in time that has been pushed to the manufacturing to just increase efficiency over time. And right now, this year at least, we saw a bunch of them breaking. There was another time a couple of years ago where it almost broke, which was when the California, I don't remember, the coastal port of Orange County or somewhere like that was on strike for a couple of months. And so there was a lot of rejuggling of the supply chain back then, but it ended up being resolved. This time around, with the pandemic, you had production shutoffs in a bunch of places for different things. And so, that really affects, output in general.
I think the key takeaway for me there, not having a terrific understanding of it, is just-in-time manufacturing is like the maybe financially optimized way for a manufacturer to do this, right? Carry the least amount of inventory, use your capital in the absolutely most efficient way, but it's risky, right? It's aggressive, both from hey, if something happens to the supply chain, and from a probably balance sheet.
And it's only been possible lately with all the computers and internet to be able to like project and predict the inputs that you need and automatically order them. Before, in like the 1960s, there were people doing charts and there were people doing other stuff, and they just carried them,
sending faxes.
Yeah. Well, not even then. Like think about like they just needed to have much more inventory. And so, and I think that was partially, if they carried too much inventory, then they stopped buying, and then you had like recessions. Right now, the business cycle has smoothed a little bit because the inventory restocking of the country is more nuanced. Like more, it isn't as volatile as it was before. But that brings other issues. I think one of the other things that happened in 2020 is the amount of inequality grew tremendously. And you can see this in the day-to-day. Everybody who had like on-site jobs who required an entertainment or anything like that needs to be face-to-face really suffered. And all those people who had educated jobs that could be done virtually, remote, or even from home really didn't suffer any consequences. And so you had this massive inequality. I think part of that also resulted in the protests.
Inequality was a big conversation the last few years. COVID, without a doubt, exacerbated a lot of the issues there and made it hard on people who were already having a hard time.
Yeah. I think though, a part of inequality is whenever you have like an economy that's transitioning from one status to another like way of doing business, I think you're going to have just a lot of inequality because it takes a lot of time for the people of the countries to adapt, right? You need a whole new generation that's going to grow into the new economy versus, the older generation. They have a really hard time converting their skill set to the new economy.
That's why demographics of a country matter so much to its market, to its job force, to its future.
Yeah, many news people have mentioned this type of recovery to be some sort of like K-shaped recovery, and I find like that definition being very much hard to explain, and not many people know about it.
K-shaped recovery, as you can imagine, is not just one line; it's actually two lines, and it's describing the divergence of the K, right? Where one side of the economy is recovering nicely upwards. You can consider that the financial economy, right? Markets recovered really well, went up a lot, right? Those are clear from the charts. Markets are happy to the point of exuberance, some might say. On the other side, there's a tremendous part of the economy and a tremendous number of people who are not recovering, for whom the outlook is worse, for whom back rent or back mortgage payments are due. So this split between the two parts of the economy is supposed to be captured in the idea of a K-shaped two economies, right? Not just one.
And you can see it also in like even states, right? You have certain states that have had tremendous recoveries or like had recoveries in other states that haven't really been able to muster a strong recovery yet. I mean, there's an ongoing secular trend in the US, at least, of the southern states, the Sun Belt, really doing better. And this, this whole pandemic situation has just exacerbated that kind of move from the northern states, the snowy northeastern states, to like the Sun Belt. I know a ton of people who have moved to Florida. I know a couple of people who moved to Texas. I remember one of my friends who moved to Texas but left his car here because he thought he was going to come back, but eventually didn't. And he asked me like if I could bring his car to that the guy who puts it on a truck and just ships it off to Texas. And he said that within this zip code where I was from, the area that they covered, to the area that was going to be delivered, they used to ship a truck a week, and now they were doing once a day.
Wow.
So there has been, I guess, like a big move out from New York State, which is where I live. I think what people have said that there's more people moving out than normal, but what is really killing it is that nobody's moving in, and you have seen big companies leave California, right?
Yep, Oracle HQ left. Yeah,
and then Elon Musk left.
I think he personally left. The factory's still in.
Yeah, the factory's still there.
Fremont.
And then something to summarize this conversation about the K-shaped recovery. Unemployment has been really tough to see, right? Like that spike in unemployment claims, new claims for unemployment. I don't have the numbers in front of me, and I'm going to show hopefully a graph. But anybody who wants to search for that graph of new claims for unemployment over a 30-year span will come to a nice surprise, or a very ugly surprise of how that graph has moved upwards. It's basically, if you look from a 30-year timeline, it's had ebbs and flows, but then in 2020 you just saw like a vertical lineup.
If you flip that chart upside down and then zoom it in a little ways, you can get to our next topic, which is something we've truly never seen before, which is the price of a physical commodity going negative.
Yeah, well, and that is oil, right? It was future delivery, right, of oil.
I think it was futures contracts that were set to expire within the next couple days, maybe. Yeah. So when a futures contract expires on physical oil, technically you're supposed to be taking delivery.
Exactly. So that means you're actually going to hold the physical commodity. You're going to transport it. Right. You're going to pick it up in your truck and move it wherever you want to move it. But you're actually going to go and pick it up. But I think it was also one of the big ETFs of oil that covers oil were reorganizing their futures contracts to move them further out, right? So they were selling the short term future contracts that were always rolling over and just buying longer term and trying to model out the same price of oil at ETF, ETN, I think it is called, an exchange traded note. There's an interesting article in Bloomberg, I think, about some people who traded that commodity like the day of the inversion.
I remember that. That was a great article. I also recall that there were a driving force was the literal physical capacity of, I believe in Cushing, Oklahoma, storage was truly overflowing, right? You could not purchase more storage, right? At the big institutional place to get that done.
Going forward is, what will happen in 2021 and 2022 about oil? It's well known that the U.S. is the marginal producer, right? So whenever oil goes above a certain limit, they just they start producing more oil, and the price will go down again. I think it's been very frustrating for those countries, OPEC countries, that you have this type of marginal producer out there that can move markets.
Yeah, the OPEC is the Fed of oil.
Yes.
I did not come up with that, but I'm repeating it.
I did not know that. You could just.
I mean, it's just like a comparison point, right? Like the Fed can do whatever they want. For instance, the Treasury bond market, they're the elephant in the room, right? They're a whale. They can move markets in all sorts of ways. And OPEC is the Fed of oil, right? They can move prices as needed to convenience their agenda.
Exactly. And now they've cut production over the last year, I believe. But the price of oil hasn't really moved up very much. And there's a reason for that. And it's we're not traveling.
Right. Energy usage down.
Yeah. So the next topic is Fed balance sheet.
Oh boy. The short and sweet here. The balance sheet of the Federal Reserve went from, correct me if I'm wrong, $4 trillion-ish to $7 trillion-ish from January to now. So a massive expansion of how much they have and how much they're managing.
Do you think a lot of that money ended up in the stock market somehow?
So the first time the Fed started massively expanding their balance sheet post-crisis, there were a lot of people who thought that this meant, because it's, quote, money printing, this ipso facto inflation, right? We're definitely going to see inflation because they're printing so much money. And I believe Jim Grant has written since then that the thing that he got wrong about that is that the Fed printing money lacks a mechanism to get it into the real economy. It just goes to bank balance sheets. The Fed being sort of a conglomeration of big commercial banks. So it doesn't necessarily translate to money velocity, which would be needed for inflation to happen. There's, of course, a million more pieces within there. I'm not a macro expert.
This time around, they bought a lot of credit assets, right? So if you buy a lot of assets in one area, it's going to push people who sell that asset to other areas, and that's kind of broadens the effect on the market. For me, the question is, do you think the Fed is actually the reason why we have this high valuations in a bunch of companies right now?
It's a reason.
Yeah.
It's saying it's a complex system. Saying it's the reason is, I think, a little reductive. But is it a reason? Yeah, absolutely. The Fed put, as they call it, is, I think, definitely real.
Yeah, and the Fed put is essentially they take out the risk of the market falling apart, and as a result, everything just rises up because there's less probability of failure.
Right, and you know that the Fed has your back in case the market starts to stutter.
Which I think is a little bit sad, right? Because you have now a system that probably cannot tolerate a ton of volatility.
I would agree. Volatility suppression, lack of interest rates being, interest rates are the most important price in finance. I maintain that that's absolutely true. So manipulated interest rates in whatever direction they're manipulated, I think causes a set of ripple effects that are with untold levels of consequence to them.
Yeah, I would say asset price inflation. specifically in which eventually just starts to spill over into the real world.
Mm-hmm.
So with that, do you think the Fed balance sheet will actually continue to go up over 2021 and further along? Well, what's the expectation there in your mind?
Not an expert on that at all. I expect more of the same. The Fed has to not only do they do what they do in the actual open market, but they also, their announcements are like surgically dissected by the market, right? Whenever the Fed makes a written or public announcement, it's very, very important the tone and the exact words that they use. So they're signaling about their future plans is also very important to markets. And they said this year that they want to target a little bit more inflation.
I think what I've learned since 2008 is like really don't fight the Fed. Do not, believe when they have an objective in mind, they will accomplish it, and they will use all tools necessary in their power to do that. You have stories where some big hedge fund will fight, an international central bank and maybe win, but that does not happen in the U.S. The Fed will win.
Yeah.
I think the other thing you mentioned here was the manipulation of interest rates, and we've seen a dramatic fall in the long end of the interest rates. So meaning like the 30-year interest rate, which has had an effect on mortgages, right? To me, that's a little bit concerning as a future home buyer. I love cheap mortgages, but the issue there is like I've found that housing prices have gone up through the roof, and that's not only because of the mortgage rate. It's also part of I think, in my opinion, it's part of the demographic move of the millennials, and also, the millennials discovering, the suburbia, the benefits of
Right.
it, and how that's could be an option. But also, I think there's been a lack of new construction of housing in the last decade, and that has really pushed up the prices here. You probably advise retirees or other more people who are nearing retirement? How do you manage that?
It's really hard. The first thing you do is you lower your expectations for future returns.
Yeah.
If the stock market's expensive and the bond market's expensive, if that's the case, and I think that's a fair statement today. The stock market is expensive and the bond market is expensive. That means that the inflation in the amount of assets you need to produce a durable income is very, very high, right? In the past, you could use $1 million, put it all in treasuries, and go to market. That's that at current prices, I believe, I don't know, 60, 70 basis points. So $1 million gets you maybe $60,000 of income. That didn't used to be the case.
Yeah, it's very unfortunate. It becomes very difficult for someone to project forward their retirement when they've saved a certain amount, expecting a return through fixed income, and it's now totally degraded. I think that's one of the unfortunate aspects of interest rates. But on the other hand, companies, you have a lot of companies who are dependent now on those low interest rates. So, hiking those or raising those interest rates will likely force undue hardship on the companies, which then will force those hardships on the employees. But I guess, those are the decisions that a Fed chairman has to take. Not my problem, or no, my problem, but nothing I can do about
it will be your problem. Right. But that's why this trickle effect of how many things that interest rates affect are why I stand by. That's the most important price in finance by far.
I think interest rates, if you get interest rates, you will likely understand the markets in a much better way. Moving on from our review of 2020, more or less, I want to discuss something today which is kind of timely. The COVID care package. I call it the airlift of money. there were two bills essentially that passed together: the omnibus bill, or whatever they call it, the expenditure bill, like where they allocate money everywhere, and the other one, which is the COVID bill, right?
Yeah, I think we can definitely become Japan and have a zombie economy with a lot of non-productive assets, non-productive companies, and kind of just scoot along. Japan 91 until today. I think if you own the total market, it's like flat for that whole time.
But
Very low
but
growth,
the,
aging demographics.
I actually think that the way out of that is just like a burst of inflation. A couple of years of 5 to 10% inflation will eliminate a large chunk of that debt, right? Because the economy on the nominal basis grows that amount, and the debt will remain where it is, and it will force governments to become less, carry less deficits, right? Because the cost of debt will rise, might raise taxes as well, but at some point, that debt will be reduced as a proportion of the GDP by inflation. I think it's the only way. Unfortunately, I don't think fiscal policy will be done.
Be the way
Yeah,
out.
I don't think
Yeah,
so.
yeah, yeah. Both of those look. But by the way, inflation and deflation. Too much of either is bad. It's bad for the average person. It's bad for the
It's
government.
bad for
It's bad.
valuation also of companies, right? Like there's a perfect amount,
Yeah.
which is like around like 2.5, 3%, or between 2 and 3, I think. Um, Anything more will reduce the valuation of companies. Anything less will reduce the valuation of companies.
I think that's an academic number, and I know the Fed has adopted it, right? So there's very smart people who agree with that.
It is an
I
academic
tend to,
number. Yep.
I tend to be a little more skeptical that there's like a right number for inflation. I tend to think there's probably a natural number that's not so much managed.
It's not the right number. It's the number that has left historically with a higher valuation. That said,
Mm-hmm.
valuation is not just dependent on interest rates. It's dependent on a bunch of other factors. But
Right.
that's just the historical where it's come out. I really think, like, I've seen inflation, how it's affected other emerging economies. It destabilizes truly a country for the first couple of years, and then things return more or less to normal. I think there's another two things I wanted to talk about today, which is mostly around ETFs. The first one is DFA. The company is called Dimensional Fund
Advisors.
Advisors. Begins offering ETFs. They were usually only exclusively mutual funds, right?
DFA is an interesting company. If anyone's not familiar, they started I think late '80s, early '90s on the back of some of the research from Ken French and Eugene Fama around the value factor, specifically saying you can outperform markets by allocating to companies with a low book to value. Right, book value is the value of their assets on an accounting basis compared to the market value of it, book to market. Um, they had tremendous success over the 90s and I think 2000s, and I think 2010s as a shop that was democratizing kind of a high level academic approach to finance. They attracted, I don't know how many tens, hundreds of billions of dollars of assets under management, but they were exclusive to advisory firms. So you had to use a financial advisor to get into these mutual funds. They were not purchasable outside of using a financial advisor. So they had the financial advisor kind of channel, the sales channel, very, very dialed in. And there's been pressure, big pressure over the past few years for them to change that model. And this year is the year that it appears to have broken.
DFA doesn't have the success that they had previously in the previous decades.
Both with performance and asset gathering, right? Because
Yeah,
if you're in an investment management shop and you're offering funds, you have your funds performance, right, which is how the investments did, and then you also have your ability to gather more assets, right?
that's right. Well, I mean, there's a couple of things that have happened in the last 10 years that has kind of rocked their intellectual boat, I would say. One is value has not outperformed growth in the last 10 years. I mean, and then it's just they have not, and they are biased. They're biased towards value, and so they have not been on the right side of the last 10 years. And the other one, I'm not sure about this one. I don't know if small cap has outperformed large cap. My guess is it hasn't.
No. I'll go out on a limb and say no way. 5 year, 10 year, no way. Small cap on on a relative basis outperformed just large cap.
And so two of their main factors have underperformed. The bets that they have taken have underperformed. And so unfortunately, I think for their side of things, I think that's kind of the rationale around those changes. Advisors are no longer probably pushing them as much. It's become way more competitive. Vanguard has come out, with full force against, with just index. Index has outperformed them.
Yep. And I think you can also replicate what's going on inside DFA funds using Vanguard and iShares, right?
Correct. Yep. That's right. The factors that they're using. And what are the factors? It's not only small versus large, low book values versus high book value. It's also, do they also have come out with momentum factor? I don't know this.
As an advisor, just so everyone knows, you have to go to like a multi-day conference to learn what's going on inside DFA funds. And then you have to tell them that you're only going to use their funds for your clients. So it's they've made a very big deal about being a DFA advisor or not, right? It's a black and white
thing. Is it
thing.
Exclusive? Do you actually have to use them exclusively? I thought you could
have to commit. I recall talking to them in like 2014, and the line was that you had to commit to, hey, this is going to be my main thing, right?
Got it.
You have to give a verbal.
And they're a little bit more expensive than like Vanguard funds, right?
Slightly more, yeah. They're in like the 30 basis points to 50 basis points range when you could get the same for 5, 10, 15 basis points from Vanguard or iShares.
I will say though that their ETFs are priced lower though. I think that's the case. But also there's a tremendous amount of pressure there. The other topic I wanted to talk about today is Vanguard ETFs. Speaking of them, their flows in the two main funds, I would say the total stock market ETF, the US one, VTI, I think it was negative for this year.
That was wild. You told me that. That's hard for me to believe. Vanguard has had such incredibly positive flows over the past few years that any outflow is a surprise to me.
Year to date, minus 3.7.
Wow.
Yeah. That said, though, their total assets under management have breached the $1 trillion. And the reason for that is just, outperformance.
Mm-hmm.
So it's been $1 trillion in ETF is insane.
Is that just in ETFs or is that ETFs and mutual funds?
I actually don't know 100%.
Yeah, I suspect it's both because they have so much money in workplace 401ks, for example. And those are mutual fund
I think
heavy.
it's total. It's all in.
Mm-hmm.
The other one that has had tremendous outflows this year, which is not even because I would say 4 billion out of $1 trillion is nothing, right?
Yeah.
Like it's just like the headline, right? This one though is a little bit different though, which is a VXUS, right? The Vanguard Total International Stock, which is I would say if you have two ETFs, right? You have the US total stock market, and you would have the other one, which is Vanguard Total International Stock Market, right? So ETF VXUS. That one is the flows are down, or from now when I'm checking it, the year-to-date flows are minus 30, almost minus 35 billion.
Wow.
And the total assets under management is almost 410
billion.
Yeah.
Wow. So that's a big, not a drop in the bucket, close to 10%.
Exactly. Yeah.
I would have thought that most of the people who were holding something like VXUS wouldn't have changed their plan in 2020, right? But perhaps there's probably a huge market of institutional investors, market makers. People are using that as kind of a tactical tool in their portfolio. I suspect that's probably to blame.
Yeah. And ARK is what the flows are. How much are they? 50 billion this year? 40 billion?
Up 50 billion, yeah, something like that.
That's insane. And their performance also. What is it called? The ARK Innovation, which is I think their main one.
Yep, that one's up 100. Their genomics one is up maybe 200%. We've had insane performance this year.
Yeah, pretty good. I mean, my hope is that it lasts. My fear is that this is kind of a Janus style fund, where in I don't know if you remember in 2000, they were like the top performing fund. Had a ton of inflows because their performance was wild.
Yep.
In the .com boom, and then they became unknown afterwards until they hired Bill Gross. I remember when I saw them in the news again.
Right.
I'm not sure where he is now, but that's another topic for another day. Anyway, so next episode we'll talk about what to expect in 2021. What do we think is going to happen? And then you can hold us to the fire
on our predictions
at the end of the year.
That'll work. Yeah, everyone write it down, take notes.
Yeah. If you like the show, please subscribe. It's really helpful for us to continue to get motivated and get out here and record. It's been great having you again.
Of course.